Thank you very much to everyone here for joining. We're here to talk about cleaning up and de-risking the intercompany loan spaghetti. So we're talking about intra-group financing for transfer pricing, compliance purposes, but also for other purposes as well. I'm really happy and excited to have as our special guest today, Margaret Alexander from Moody's. And Margaret, perhaps you could just say a few words and introduce yourself.
Yeah, sure. I'm really happy to be here speaking about this fun topic. I'm the industry practice lead for the tax and transfer pricing products at Moody's, and specifically for the Americas region. I've been at Moody's for about 2 years, but before that, I was a customer for over 15 years. So I've been using the products for a long time.
Great, thank you. And as regards the agenda today, so we're going to talk about situations where multinational groups are facing a situation where they have undocumented loans or issues with the commercial rationality of their loans or issues with the pricing of their loans. And so we're going to use this time to talk through some typical scenarios, things that we often come across, and we're going to briefly dive into some recent case law examples, really just to illustrate what it is that we're up against here. We're then going to talk about triggers and drivers for actually taking action to rationalize intercompany loans as opposed to deferring the project, and we'll touch on project planning as part of that. We're then going to do a refresher on key elements of the fact pattern, and then after that is the section which is really to allow Margaret to talk us through how loan pricing tools actually work, what kind of functionality is available and what support is available in terms of you using that, whether you're from a corporate background or an advisor background. And then we're going to wrap up with some Q&A. So if you do have any questions, we'll do our best to address them at that point. And then we'll wrap up with some key takeaways. So in terms of housekeeping points here, we will do our best to record this and to release the recording, but I can't promise right now because in the past we haven't done that. So I'm relying on our amazing technical team to help us through all that. And as I said, if you do have questions, please use the chat function or the Q&A function on this platform, and we will do our best to get to them. So, common scenarios in terms of intercompany loan spaghetti. So a number of the clients that we speak to have a situation where they have multiple intercompany loan balances which may be undocumented, so they don't have any consistent pricing policies in relation to that. One of the major issues from a practical perspective that we come across is lack of corporate memory regarding the purpose of loans. And that's for the basic reason that sometimes the people who were around when the loan was first put into place or the balance first arose are no longer around. So what do you do in that kind of situation? Also, lack of commercial rationality on the inception of the loan. So we'll give some examples of that. And also just complexity of the portfolio of loan balances. The last one on the list here, I know something that, Margaret, you often get brought into or asked to help with.
Yeah, the situation that I saw most often from the ones on this list, it's also the one that probably was the most difficult to deal with. It's where clients would come to us and they would have already set the terms and the conditions of the loan. They would have already decided on the interest rate that they thought was appropriate. A lot of times they would have already had several internal meetings, gotten management approval in some cases. A couple of times the money had already been transferred, and they come to us wanting us to document what they've already done. And, if we can, if it's supportable, that's fantastic. But, several times it wasn't. And that puts the consultant in sort of a precarious position where you want to make your client happy, but at the same time, you want to provide documentation that is supportable. And asking a client to go back and redo everything after they've spent a significant amount of time working on this already, that doesn't really make anyone happy.
Yeah, totally. And that's something that we come across a lot from a legal perspective. So for those who don't know us at LCN, we specialize in the legal aspects of intercompany group structure design and intercompany loans. So we work alongside transfer pricing advisors, whether they're in-house or within advisory firms. And one of the key issues in any situation, whether it's loans or other transaction types, is when you're coming in and this is a situation or this is an arrangement that has been reflected in accounts or filings for a while, and the difficulty of retrofitting documentation and pricing in that situation. So we'll come back to this a little bit later. So as I mentioned, I just want to give a few examples. We won't have time to go through the facts and the decision making in any detail at all, but really just to illustrate the nature of the problem. So this is one Australian case from 2021. It involved Singapore Telecom, and the scenario was that the group had acquired a third-party business in Australia. It was actually acquired from Cable and Wireless. And immediately after the acquisition, it put in place a new holdco structure and refinanced that holdco structure. And as part of that, there were approximately 5.2 billion Australian dollars of loan notes that were put in place between these entities within the structure that were in effect wholly owned by the Singtel parent. The problem was the lack of commercial, or one of the problems was the lack of commercial rationality in the arrangement. So when this loan note was put in place in 2002, it was on a floating rate for interest rate purposes, and it was actually repayable on demand. And immediately just looking at that from an outsider's perspective, it did not make sense, because the projections in terms of the performance of the underlying business meant that the acquired group was not expected to become cash flow positive for, I think it was around 4 years. And clearly it did not have the ability to satisfy a demand for repayments on day one, and was not able to service the loan instrument the interest arising on the loan as it became due under that instrument. And so that meant that almost immediately after the inception of the arrangements, it had to be restructured so as to push out the repayment date and make it a 10-year instrument as opposed to repayable on demand. There was a further amendment to create an interest-free period reflecting the cash flow reality of the group. And then there was a further amendment which was in effect to fix what was previously a floating rate. And the main issue in terms of, or one of the main challenges that was faced by the court in Australia in dealing with the ATO challenge, is the lack of documentation as to the commercial rationality of the original arrangements and each subsequent amendment of it. And I guess it's an advisor's nightmare, because ultimately the court was having to look at exchanges of emails between Singtel Group and its advisors, one of the big four firms, saying, should we do this, should we do that, and let's set it at this. And that was basically because of a failure to document the rationale and to price the transaction appropriately in real time. And I guess, Margaret, that just kind of reaffirms your predicament when you are asked to retrofit analysis to something that's already happened.
Yeah, absolutely. And there were a couple other things about this case that jumped out at me related to the guarantee or lack of guarantee, where the parent company had just I think like a month before provided a guarantee to a different subsidiary. And so to have a guarantee given to one subsidiary and not to another, especially given the size of this loan, to not factor that in when you're thinking about the credit rating and the interest rate, I think that would be unusual, especially because of the size. You would think that the parent company would want to if this were in a third party situation, they would want to reduce the overall borrowing costs for the group. And the way to do that would be to provide a guarantee for the subsidiary so that their third party interest rate would be lower. And that would be what you would typically, want to see between related parties, but you didn't see it here. So there were a lot of things that caused this to be a mess.
Absolutely. Second example I want to give is the UK case of BlackRock, and I know a lot of people on the call will be familiar with that. And for the purposes of this conversation, I really just wanted to flag certain aspects of it. One is that the HMRC challenge to the arrangements was on two grounds. One was unallowable purpose, which related to UK domestic law, and the second was on the transfer pricing challenge. And the background here was somewhat similar to the Singtel case, which is what had happened was that BlackRock had acquired a third-party business, in this case from Barclays, and had put in place an intermediates holdco structure involving UK entities being inserted between really what were the principal entities in the US, and that the UK entities entered into a loan arrangement including $4 billion of loan notes. Part of the issue in terms of the transfer pricing challenge was around commercial rationale. So at the first instance, in relation to this decision, HMRC's challenge was upheld on the basis of a really binary view of the world. It was saying that in the absence of covenants or security over the underlying assets from the borrower, a rational third-party lender would not have lent at all, and therefore no transfer pricing, and therefore transfer pricing challenge upheld, and therefore no loan interest deduction. The qualified version of that decision on appeal was that yes, although in this situation where it was a loan from, in effect, a parent company to a wholly owned subsidiary, the presence or absence of security did not make a difference in this situation. What the court did reaffirm was actually the position would have been different had there been prior ranking security in relation to the underlying assets. And so for me, this case really reaffirms that you need to look at the commercial rationality on inception. Security, or as per Margaret's point, guarantees or parent company support can be a critical part of that commercial rationality, and therefore it needs to be factored in terms of the documentation as well as the analysis.
Right. And in this case, the optics were just bad. So the use of a debt-funded UK resident entity in an otherwise wholly US-based and equity-funded ownership chain, in a structure that ensured that the UK entity didn't have any control over this company the group was acquiring, the optics are just bad. I'm not sure, why they thought that wouldn't be questioned. That was my first reaction. But then my second reaction, had to do with this separate set of UK specific rules, the unallowable purpose rule. And I think it's really important to recognize when other rules or regulations intersect with transfer pricing rules. So you have this UK rule, you have the US GLAM, the Generic Legal Advice Memorandum, that covers use of implicit support. And there are various other countries' rules like related to deductions or deductibility of business and interest expenses, or regarding the levels of debt that are acceptable versus equity. So I think it's important to always, think a little bit beyond just the transfer pricing rules and look into any other rules that might be applicable given the jurisdictions where the entities are located.
Totally. So the final case law example is a really narrow point. It's the Swedish case of Nobel Biocare, and the situation in essence was that loans had been put in place. They were documented on a long-term basis, so 15 years and 30-year terms, and there was no provision in the loan agreements which allowed the lender to require early payments without cause. And what happened is that the taxpayer purported to reprice the loan by increasing the interest rate without regard to the actual terms of the agreement. And unsurprisingly, the Swedish tax administration objected to the increase, and that was upheld by the Supreme Court in Sweden. So it really just links together with the overall point here, which is on the inception of the loans, it needs to be documented. The legal terms is are a critical part of that. And having done so, you can't just ignore them when convenient. You need to document the rationale for any amendments in real time.
And we need to remember that things change, and 15 to 30 years is a long time. So right, you could expect credit ratings, to change over, at the least you could expect credit ratings to change over that amount of time. So maybe to allow for a little bit more flexibility, they could have set a shorter term for this loan, or used like a 5-year floating rate loan rather than this really long drawn out term.
Yep, totally. Final mini example here is just to give an explanation or a brief illustration about how legal aspects can fit in. So here we had a situation where it was a group company, or sort of group of companies. There was a loan made by entity A to entity B. It was documented as repayable on demand. During a specific period of time, in fact, it was during COVID, entity B was going through solvency issues, and in order for its accounts to be prepared on a going concern basis, it wanted to redocument that loan so that it was a 12-month term as opposed to repayable on demand. The issue was, at that point, entity A had negative reserves, and it was actually an ultra vires transaction from entity A's perspective to vary the loan terms in that situation. And so this was a sequence of steps which looked perfectly rational at the time and made sense, but unfortunately it didn't take into account the relevant stakeholders, which included in this case the fact that entity A had negative reserves.
And in this example,
Sorry, yeah.
usually I have an idea about what I think is the right way to handle this, or the right way a court should rule. But for this, I'm kind of on the fence, because if you have an agreement, like my initial reaction is, okay, the agreement is set and it shouldn't be changed, because third parties wouldn't necessarily change their agreement that they've entered into. But at the same time, as an independent lender, if my choices are, receiving, partial payment or no payment, or, waiting some amount of time and then getting full payment, I'm going to be okay with waiting some amount of time for that full payment. So I'm kind of torn between which way I would rule if I got to make the choice as a court.
Right, and I guess what one of the key messages here overall is we've got to have humility that yes, we may endeavor to be experts in particular areas, but we don't know all the areas. We can't speak for all the stakeholders, which may affect different choices, and it means identifying as far as possible the circumstances in the round, the stakeholders in the round, and then making a decision and documenting it on that basis.
Yeah.
So I'd like to move on, and Margaret, maybe I can ask you just to talk us through what you see or what you come across as what are the triggers that make a group actually take action now, as opposed to sort of leaving it as item 20 on a to-do list.
Yeah, definitely. I love this slide. I love it, but at the same time, I hate it because it brings back some bad memories for sure. So some of the items on this list involve a more extreme downside than others, but really for all of these situations, you want to put some forethought and some effort into getting your loan spaghetti sorted before you have to deal with these. For me, the worst case scenario would be going into a tax examination and not being prepared with respect to my documentation, my agreements, my transfer pricing reports, documentation of the actual actions and behaviors, all of it. Because when you don't have that sorted, you open up the door for the tax authority to question the facts and to even assert their own version of the facts. So not being prepared can also prolong an examination, and then it becomes even more costly for the taxpayer. And second on my list, also second on the list on the slide here, would be statutory audit issues. So the main objective of a statutory audit is to provide an independent opinion on whether the company's financial statements present a true and fair view of its financial performance. So you don't want to be found with a deficiency where the auditor may need to express some kind of adverse opinion on the financial statements because you can't support the position you've taken with your intercompany loan. Your financial statements are important, not just for investors, but also because they're used to satisfy other requirements. Sometimes banks will request those. Your customers might, suppliers might, who want some kind of assurance of the company's financial health. And significant audit deficiencies can damage a company's reputation. It can lead to a loss of confidence. It can also lead to increased scrutiny from regulators in your industry or potential fines. So it's quite important to have all of your ducks in a row before your auditors come in. I also want to mention the exit readiness because this really is often overlooked and it's quite important. So if you're planning the sale of your business or some sort of exit transaction, you want to have your transfer pricing really well documented. And this is because during due diligence, a potential buyer will want to understand how reliable or how risky your transfer pricing positions are for the open tax years. So if your transfer pricing is seen to be risky, the buyer may want you to put some amount of money in an escrow account until the open tax years close. And this money, it would be used to address any audit situations where the transfer pricing positions aren't upheld. So even if the seller is able to retake all of this money when escrow closes, all of that cash would have been tied up for years. And that's never optimal. It's cash that you're not earning interest on. It's cash that you don't have to use. Another situation that can be overlooked relates to changes in economic conditions. So if your loan agreements aren't very robust and they don't account for changes in circumstances, this can cause a real problem if there's a change in the wider economy, a change in the economic circumstances in the country where that borrower is operating, or even just a change in the industry that it's a part of. So a company's ability to adjust can be limited depending on the terms of its contract. Paul,
Right.
did you want to
Yeah, I mean,
add?
so I guess, you could say these triggers fall into different categories because one set of triggers relates to external processes or events like preparing for an IPO or preparing for an investment or an exit or something like that, or statutory auditors raising the issues. Others can be just a function of risk appetite or risk tolerance within the group as a whole, particularly having regard to the change in circumstances. I think we'd all agree that the transfer pricing environment is totally different compared to what it was 5 years ago, 10 years ago, and we've had all this litigation, including Amgen, in terms of investors raising issues and pursuing claims for failure to disclose uncertain tax positions or tax liabilities. So it's definitely part of the equation here. Cool. So we've already talked about this subject already. We've touched on this. So just the importance of identifying the stakeholders in terms of the design or redesign or restructuring of intercompany loans. And this slide is not attempting to cover everything, but it really just is to remind us all that things like choosing at random duties to third parties. So there may be contractual restrictions on the ability of particular group entities to use cash. So for example, if they've received government grants or third-party loans, there may be contractual or legal restrictions on the ability of that entity to lend that money to other group entities, particularly if it's overseas. And of course, the impact of third-party security and third-party loan terms. And similarly, I really want to single out solvency risks as part of the stakeholders here, because it can be tempting to say, well, we're just pricing things for tax purposes, and that's why we're doing it. But the fact is that I think more than any other transaction type, the terms and conditions of loan balances are extremely transparent and have an extremely direct impact on whether directors of legal entities can say, I have properly considered my fiduciary duties as a director, including my obligations to have regard to third-party creditors and so on. So I really just wanted to flag that as a key thing for initiating any project, which is basically to go through the exercise of identifying who the stakeholders are.
Yeah, and often it's the treasury department of a company that's the one who handles the intercompany payments. And so they may be the ones who set up the terms or set up the actual transfer pricing policies. And when they do this, they may not have transfer pricing, at the top of their minds. So they might not necessarily consider the same things as what the tax department or the transfer pricing group within the tax department would consider. So it's just to highlight the importance of having all the necessary stakeholders working together to ensure that you have results that are supportable.
Totally. In terms of the timeline, this diagram, some of you may have seen this in the context of other webinars and other transaction types. It's really just to reinforce the points that if you're dealing with a situation of a corporate which has an issue, in other words, undocumented loans or potentially commercially irrational loans, it can be difficult to decide where do you start in terms of cleaning up the mess. And there's always this fundamental decision, which is, okay, so right now, here we are in June 2025, in the middle of a financial year. What are we going to do? Are we just attempting to regularize things from now on? So from maybe 1st of January 2025, are we trying to retrospectively go back that far? What about 2024? Is it even possible to redocument or rationalize the pricing of loans for that prior period, given all the health warnings that Margaret you've given already for that? But this is one of the fundamental decisions that is faced with any kind of project, whether it's loans or other transaction types.
Yeah, I think it's even if you haven't documented something, at the appropriate time, when you entered into that transaction or, hopefully a little before that, I think sooner is better than later. It's always better to try to, put together all the pieces of your case that you might need later down the road.
Right, and this is in the context of the reality that many groups are in transition towards a compliant, contemporaneous approach to documenting intercompany transactions. So we work with a number of large corporates who are ultra hot on this and have systems and processes to ensure that this is the case, but others are still playing catch up, in which case they're faced with this decision. Are they just going to document the current year and then get into a proactive, forward-looking process for 2026 onwards, or is there anything that presents a specific risk in terms of historic years that need to be looked at now? Key elements of the legal and commercial fact pattern. I'm just going to go through this briefly, but it's really at the core of thinking about that, because there is the temptation just to divorce loan transactions from the rest of the transfer pricing policies. But just as for any third-party transaction or third-party scenario, it's actually, you can't design or price one without the other. You can't create a so-called limited risk distributor and price that if the reality is that distributor, for example, contributes to cross guarantees in favor of a third-party lender and therefore is de facto exposed to the whole risks of that third-party loan arrangement.
Yeah, in a bit when I'm off my corner. Can you do what I've asked?
Oh. Sorry, someone seemed to be unmuted there. So, but first is understanding the business models of the respective entities, understanding the shareholding and control structure over the borrower and assets. And part of the reason for that is that, as per the BlackRock decision, while as between a parent and the immediate subsidiary, that relationship may mean that the impact of security and covenants intra-group is less, that analysis wouldn't necessarily apply to a sideways loan and certainly not to an upwards loan. So understanding the shareholding relationship is actually critical to understanding what is going on there. Clearly, the position of third-party lenders, creditors, security interests, and ranking of debt. I know this is something that your tools, Margaret, very much focus on, but without understanding that, you actually can't begin to price the loan in terms of the credit rating of the borrower and the credit rating of that instrument. Regulatory restrictions and legal restrictions. So obviously for regulated groups, regulatory compliance pretty much trumps everything else, because that is the ticket to play. And therefore understanding the regulatory status of the relevant entities, including other restrictions, legal restrictions on the ability of parties to borrow or lend are really critical. And then finally, on the top left grouping, solvency considerations. To the extent that specific entities have issues such as negative net assets or negative reserves or anything like that, it means that we collectively, in our role of keeping the relevant people safe, mean that we need to be extra careful in terms of the design of the transactions, because if that solvency situation were to, or insolvency situation were to materialize, then the relevant liquidator would basically look at the conduct of the directors of that particular entity and consider whether actually the directors involved have properly complied with their duties. Options regarding sorry, go ahead, Margaret.
Yeah, no, go ahead. I'll jump in at the end.
Yeah, I just wanted to talk briefly about options regarding the legal form of the debt. So in many situations, you can replicate the same commercial terms, for example, as regards term and interest rates and security, in different forms. So as loan agreements or loan notes or promissory notes. Actually, the form of the instrument from a legal perspective may have very important implications for other tax purposes, such as the impact of withholding taxes. And therefore, this is something that needs to be borne in mind at the design stage and the documentation stage. And the reason why we've highlighted cash pooling arrangements is that I would say they are almost by definition high-risk arrangements, because when you think about it, a participating company is giving up control over its own liquidity. It is relying on the credit rating or the credit worthiness of the cash pool leader, may need to insist on explicit parent company guarantees. So I would always regard that as a high-risk transaction type from a legal and governance perspective, irrespective of the TP analysis. And then on the right-hand side, I guess these points are obvious, but I would really highlight the purpose, documenting the purpose of the loan. This can be partly a function of the loan agreement or the transaction documents. Certainly needs to be documented in the form of board resolutions or board briefing papers, because it is such a critical part of understanding or explaining, recording why the loan was put in place to begin with. Margaret, did you have anything else to add to this slide?
I don't think we can say enough times how important the terms and conditions are. They're important from defending the fact that the loan is in fact a loan, that it's debt and not equity, and defending the fact that the amount of interest paid was reasonable, or, I just think with some forethought and, a little help from your outside advisor, there's no reason why every loan shouldn't be well documented with a complete contract. I just think that's one of the key areas where I've seen clients fall, and there's just no need for that.
Exactly. People talk about form versus substance, but obviously what we're aiming for is form aligning with substance and supporting the substance, because essentially our job is to create a consistent set of documentation so that when that transfer pricing or tax audit does happen in 5 years' time, the information is there, ready and available to respond confidently to those requests. Okay, so I'd like to move on to part of this webinar that I've really been looking forward to, which is really handing over to Margaret to walk us through how loan pricing tools work and what kind of functionality is available.
Yeah, thank you. I'm excited to talk about this. This is one of those things that when I first encountered loans and having to document loans as a consultant, they were scary, but they don't need to be scary. And we'll talk about why in just a minute, but just a little bit of background first. So over 100 years ago, Moody started off as a bond rating company, and it's expanded over the years, and now it rates debt securities and several market segments, related to both public and commercial securities. So we have a pretty long history in the ratings business. And over the years, Moody's has created various models used to determine credit ratings. And the tool we're going to talk about today, it brings together 4 general types of these models. And of these 4 general types of models, one is really used most often for transfer pricing, and within it are many submodels. The predecessor of this tool was originally created for banks, and banks used it to assess the credit of their customers who were seeking funding. So that's kind of a fun fact, but it also falls in line with the OECD guidelines, where they think that a tool will give you more reliable results if those results would be similar to what would be seen, from actual rating agencies in the market. So that's definitely what we're going to see here. And the tool that we're going to talk about today is called EDFX, and that stands for Expected Default Frequency. And within EDFX, we mostly talk about the risk count group of models for transfer pricing. And this group has specific country models built for a specific location and industry, for a specific size. It also has some broad regional models. So we'll get into the details, but first let me give you a kind of an overall high-level walkthrough of the pieces of EDFX. So we'll have a quantitative piece to the credit rating. And then there are certain adjustments that you can make, some based on time and some based on qualitative factors. And there's also an adjustment that you can make for parental or group support. So that's the order that we'll walk through things today. And so the first piece of EDFX, you enter some information, and we'll look at some screenshots. You'll enter information about your borrower, like where they're located, their industry, and you'll enter the financial data. So not even complete financial data. The model will work if you have limited data, but the results are going to be more precise the more data that you can enter. And the tool will pick the appropriate model, so you don't have to worry about, looking through the list of models and sorting out which one is appropriate for your borrower. The tool is going to do that. And one of the things that was really important to us was to make sure that everything was transparent. So you can look up the name of the model that was chosen. And when you do that, there's all sorts of documentation. You can look and see how the model was created. You can look at the validation papers. You can look at papers that explain how the tool goes, how the tool goes about creating the credit rating. So we have documentation on all pieces of the model, so that if you are ever with a client under audit, you'll be able to readily explain the model that you've chosen and how it works. And I think someone's not on mute. So beyond just transparency about the model, we wanted the tool to give transparency about the specific quantitative analysis for your specific borrower. So the tool is also going to show you the specific drivers, the specific ratios that are used that go into creating the credit rating. And they'll do it with graphs they'll do it with percentages, with percentiles. So you'll see it all. It's very clear. And we'll look at a couple of screenshots of that. And in these screenshots, you'll see that in the pictures, it's very easy to read. It's like red and green. Green is good, red is bad. So super easy to understand. And you'll be able to see the impact of each driver as well as the direction. So if we can go to the next slide. And so after you have your credit rating based solely on the financial data, then you can start adding layers to that. And the first layer that you can add has to do with timing. So you can look at the credit rating that's over the cycle of the debt. So it's going to be smoothed out. Or you can look at the credit rating that's based on the specific point in time. And so if you pick that point in time credit rating, then you're going to be adding an adjustment that takes into account certain macroeconomic factors that are affecting the particular location and industry that your borrower operates in. So that's the second, that's the first adjustment, but the second step of the process. And at all steps, you can choose to add that adjustment or to stick with your initial quantitative credit rating.
And so, sorry, Margaret, is it possible to roll back in time that point of time adjustment? Is that how it works?
Yeah, absolutely. So you can put in, it's like an as of date where you're doing the analysis as of a certain, specific day. So, yeah. And that's really helpful given, the fact that if you're under audit, a lot of times that audit will be covering years in the past. So the audit might be covering 2 years ago. So if you need to, provide some extra support, hopefully it's extra support and not initial support during audit. But if you need to provide any kind of analysis, you can put in that specific, as of date and make sure that you have data that was available just at that time. Yep. So let's go to the next slide. And so I probably should have saved the instrument pricing till the end after we talked about all the adjustments. But one of the things, if you look in the OECD guidelines, they say that you can create a credit rating based on the borrower or based on the borrower and that specific instrument. And it's going to be different. And one of the things that the tool allows you to do is it allows you to put in, after you create the credit rating based on financial data, add any adjustments that you would like. Then you can also look and see what that credit rating would be if you added in some of the characteristics of the specific loan, and they're listed here on the slide. And then you can see how that affects the credit rating, and you can choose to use the credit rating based on the instrument or based solely on the borrower.
And I guess just pausing there, Margaret, in terms of how this would, or how we would recommend this kind of process to work, from my perspective, it means designing the proposed arrangement, financial transaction, from a high level commercial, legal, economic perspective, and pricing that on a tentative basis based on the model. So these two things should work in parallel and end up with a position that hopefully is commercially rational and is as robust as possible.
Yep, exactly. You don't want to go straight to the pricing and not have all of your terms and conditions, set out. And you also don't want to have your terms and conditions and pricing set out without the analysis. So this really is a hand-in-hand kind of a process. Yeah. So let's look at the next slide. Here we go. So this is part of the next set of adjustments. And we'll look at, so these are what we call the qualitative adjustments. And part of the qualitative adjustments have to do with parental or group support. And so what we've done for our qualitative adjustments is we've created scorecards. And these scorecards provide questions and then possible answers for you to pick. And it's all it's really structured. And we think that it needs to be structured because when you make qualitative adjustments, it's, for lack of a better word, it's sort of a willy-nilly kind of a process where you can present, the scorecard to a tax authority that might have questions, and it's very clear the steps that you took. And if you use the scorecard process for all of the loans that the group might enter into, then it keeps you very consistent. And we'll look at one of the scorecards. We'll look at the scorecard for the parental and group support, but then there's also a scorecard for other qualitative adjustments also. And the OECD guidelines, they suggest that you make these type of adjustments. And because the OECD guidelines say that, they'd really like to know that your credit rating from any kind of a third-party tool would be similar to what a credit rating agency would come up with. If you add this qualitative adjustment to the ratings and then you compare that so we've done this analysis at Moody's where we've looked at the Moody's ratings for, all of the companies that we have ratings for, and then we use the tool and create ratings. If you just use ratings based on the quantitative data, there's some difference. But if you add the qualitative overlay and make that adjustment, you'll see that the ratings from the tool are very, very, very close to the ratings that our agency side of the business come up with. Then we're pretty proud of that. So let's look at the next slide. And so just in the interest of time, we can just, skip through some of these, Paul, but I just wanted to give an idea about what the scorecard looked like. And so for the scorecards, you have these general categories, and there'll be different questions within each category. And for each of these questions, there'll be a drop-down set of answers. And so that's what you're seeing here. So this is the operational integration group. And under ownership and control, you have these choices here. And you can look, if you're not sure of any of the definitions or, what does this mean or what does that mean? There's extensive documentation and definitions for all of this. But we can skip through these. Yeah.
Fine. So we're covering asset materiality, profit relative to the group. Fine.
Yep. And that's the end of that scorecard. And I know this might be a little bit small, but what you're seeing here is like the landing page of EDFX. And so if you can read this at the top, that first kind of yellow box is pointing to the model name. And so you clearly will know exactly what model is being used. And you can look up that model, find all the documentation that you need. The second box, the second like yellow pop-up box is pointing to where you can upload financials. So it's quite easy. You can type the financial data in, or there are templates where you can upload Excel sheets. And the other two boxes, the first one on the left at the bottom shows sort of the as of date. And that middle yellow box is pointing to the actual credit rating. So we come up with a probability of default, and then we translate that into a credit rating because that's what the market is normally used to seeing. And that box at the bottom on the far right is just letting you know that we have lots of white papers, lots of technical documents that you can use. So very, very transparent, like the opposite of a black box tool. So if we can go to the next two slides, I think show similar things. So on the left, you're seeing the adjustment for the point in time. And on the right, that donut wheel is showing you all of the different drivers that go into the makeup of the credit rating. And on the next, if you go to the next page, you'll see the same thing. So these are the same drivers. They're just broken down a little bit differently. Like for the growth driver, you have two inputs for that. And you can also see the weights. So the weight for growth is that 10%. And on the right, you'll see the actual percentage for these different ratios or these different rates listed for the borrower. You'll also see the percentile where they fall within our universe of borrowers. And like, for example, you don't have to have complete financial data. The top 2 items, you can see that they don't have any numbers over the colorful bars. And that's just because there wasn't financial data added for those items. So you can still get a credit rating without complete data. Let's go to the next slide. Yeah, and this is just what the qualitative overlay scorecard looks like. And you just start looking at the drop-down boxes and, choosing what's appropriate for your borrower. And then you get to see the adjustment after that. It's really a very quick process.
And Margaret, I had a general question for you, which is, how does it work? Do you just make available these tools, presumably online, and as you just go, well, off you go and use them, or what kind of support is available?
Yeah, no, we have really fantastic support. So you'll get extensive training once you've subscribed to the tool. We also have a lot of videos. So if it's, the middle of the night and you can't sleep and you decide to work, you can pull up any of those videos. We have a 24-hour email helpline that they get back fairly quickly, like usually within the day. And you can always call your customer service rep that you met during the initial sales process. So lots of different avenues for support.
Right. Cool. So I'm just conscious of time. So maybe, yeah, Margaret, we should sort of flip forward and start to hopefully pull things together. But thank you so much for that.
Yeah.
Just high level. So going back to this scenario where a group is faced with a situation of undocumented loans, maybe particular risk areas, just like any project management scenario, it's about essentially assessing the current state in terms of stakeholders, risk tolerance, and the current matrix. It's about designing the future state, and as we've discussed, it's about designing the legal and commercial terms alongside or in parallel with testing the pricing of that. So it's a parallel process that should result in a combined result. And box 3, we've touched on this already, but often in terms of how to get from A to B, the implementation is not just a matter of putting in place the new loan agreements. It's also about rationalizing loans or moving them around or documenting the reason for making those changes from one set of loan terms or one set of arrangements to another. And of course, this is not just something that happens in a single point of time. The whole objective of the exercise is to keep corporates safe, and that means ongoing processes for review of loan balances. So linking in with your point, Margaret, you don't just price a loan at one point in time. It's something that needs to be reviewed on an ongoing basis.
Yeah, and this isn't something that you can just stick your head in the sand and hope that it will go away. I know that in the past, financial transactions haven't typically been targeted, but I think they're going to be targeted more and more. So following all of these steps is only going to be more crucial.
Absolutely. I just want to leave you with a couple more things. So often it's the situation where actually there's multiple loan balances. It's an established group, different subdivisions, different business lines. And so you may need to go through a process of prioritizing which loan relationships you address first. We've just attempted to put together some of the factors that you might think about when you are deciding how to or which ones you address first. I don't know, Margaret, if you want to add to any of the points on the slide here.
Yeah, I think the most important one would be the level of debt or the amount of debt. So it's your biggest loans that are probably going to carry the most risk. Beyond that, it would be, where the borrower is located, and maybe even where the lender is located. Some tax authorities are more difficult than others, so that's definitely something to take into account also.
Absolutely. Cool. Well, we're coming up to the end of time here, so I'd really just like to leave people with some key takeaways. Hopefully it's helpful. So number one, what you just said, Margaret, doing nothing is not a viable option. The environment has changed. And just to pick up on recent developments, so we've had the recent draft practical compliance guidelines from the ATO focusing on financial transactions. I would really recommend the PCGs as worth a read, even if you don't operate in Australia, just because the risk factors and the risk ratings from a tax authority perspective are the kind of things that you probably want to talk through with your colleagues or with your clients in going through this prioritization exercise. Second point is, as we've talked about, identify all the stakeholders. So this is not just tax and treasury and legal. It's looking at it in the round. Point three, I think, is really important. So manage communications internally on the assumption that they will be disclosed, just like the Singtel situation, that horror story of the court literally reading the emails between the advisors and the client. And the same thing happened in BlackRock. So the court was actually reading through the emails that were circulated internally saying, should we do this? Yes, let's do this. And we know it's going to be regarded as aggressive because of X, Y, and Z. So it's really important to educate the whole of the team that actually, yes, privilege may exist, but you should assume that all communications are going to be disclosable. Obviously, design transaction in advance. Yes, sometimes you can document after the event, but retrofitting is always going to be difficult. And then you're left with the even more difficult question: if you decide you can't retrofit, what are you going to do in terms of your previous filings? Identifying the legal and commercial fact pattern in the round, including legal constraints. This is something that is specifically highlighted in the OECD TPG as being a relevant part of the economic fact pattern. The fact that the legal form of the debt can be as significant as the commercial term. So think about, well, does this really need to be a promissory note? Can it be a bilateral loan agreement? Point number 6, just the golden rule, which is, if you were a director, would you sign? So that's a really good filter for commercial rationality. If you were on the hook personally for accounting for how you had exercised your powers on behalf of a particular company, would you sign? Documenting the commercial rationale, so including on through board briefing notes or board minutes. I think this is more important than ever. Point number 9, as Margaret says, pricing happens, or it gets finalized after the form and substance of the transaction has been designed. So you can't price and then retrofit the documentation. And putting in place processes to maintain compliance. Margaret, any final words from your perspective before we wrap up today?
Yeah, no, I think those takeaways were perfect. I would just do my best to keep all of these in mind when setting up a loan transaction.
Absolutely. Great. Well, all I can say is thank you so much, Margaret, for spending your time with us. I've really learned a lot. Thank you for everyone attending this call, and we look forward to being in touch. Thank you.